All right, let's jump right into this masterclass case study. Today, as an expert investment analyst, I'm going to walk you through a complete stock analysis, putting NXP Semiconductors through a pretty intense financial gauntlet. We're going to use the valuation frameworks of some of the most legendary investors in history. We'll crunch the hard data, break down the numbers, and figure out exactly what this semiconductor giant is actually worth today.
Here's our roadmap for this explainer. We'll start with a company snapshot, then view it through the Buffett lens, the Lynch lens, and the Graham lens, before moving into DCF and valuation models and wrapping up with a final synthesis.
Starting right off with Section 1, Company Snapshot.
What's really fascinating about NXP is how heavily weighted they are toward the automotive sector. I mean, we're talking 58% of their revenue coming from auto. They are a dominant, deeply entrenched player in software-defined vehicles and radar. You've also got industrial and IoT at 19%, mobile at 13%, and communications infrastructure sitting at 11%. But make no mistake, automotive is absolutely the engine driving this company.
Just to ground us in the hard data, as of July 2026, NXP trades under the ticker NXPI at $266.53 per share. This is a massive enterprise, boasting a $67.29 billion market cap. And when we look at the trailing 12 months, or TTM, they're pulling in a highly respectable $12.6 billion in revenue and clearing $2.65 billion in net income. So right out of the gate, we've got a highly robust, profitable foundation for our valuation models.
Moving on to Section 2, the Buffett lens. So what does the Oracle of Omaha actually look for? Well, Buffett wants businesses he can clearly understand. He demands a durable economic moat, super consistent earnings, high returns on equity, strictly manageable debt, and plenty of what he calls owner earnings, just to make sure he has a sufficient margin of safety.
And you know, this is where NXP really delivers on quality. They boast an impressive return on equity of 21.07%. Their owner earnings, which we're approximating here using the trailing 12 months free cash flow, sit at a massive $2.96 billion. Plus, with that 58% exposure to the specialized auto market, the economic moat is definitely intact. The only real hiccup? A debt-to-equity ratio of 1.04, which is honestly a bit borderline for Buffett's traditionally conservative tastes. Weighing all of that together, Buffett would absolutely love the cash flow generation and their market position. But that $11.7 billion in total debt and a debt-to-EBITDA ratio of 2.53, that introduces a level of leverage that might squeeze his margin of safety just a little too tight. Because of that, Buffett would likely view this as a fantastic, high-quality business, but he'd probably wait for a slight price pullback before he actually pulled the trigger and initiated a buy. All right, on to Section 3, the Lynch lens. Peter Lynch's checklist tells us we first need to categorize the stock. Is it a fast grower, a cyclical, maybe a stalwart? After that, he leans heavily on the PEG ratio, balance sheet strength, and insider activity. Now, while our specific data sources today don't have the latest on insider or institutional buying, so we'll just assume a neutral stance there, we can confidently categorize NXP as a stalwart. It's a large, deeply entrenched company that still manages to offer reliable growth. And this right here perfectly illustrates Lynch's absolute favorite metric, the PEG ratio. By taking the price-to-earnings ratio and dividing it by the growth rate, we see NXP's trailing 12-month PEG ratio sits at a highly attractive 0.94. For Lynch, finding anything under 1.0 is basically the holy grail. It strongly suggests the stock is currently undervalued relative to the growth it's actually producing. On top of that, NXP's forward PE is dropping to a really appealing 1698. Throw in a healthy current ratio of 2.24, which proves they have excellent short-term liquidity to cover their obligations, and Lynch would likely be all over this stalwart. Under his framework, this data triggers a compelling buy, or at the very least, a very strong hold.
Next up, Section 4, the Benjamin Graham lens.
The father of value investing is absolutely ruthless on price. Graham demands adequate enterprise size, pristine financial condition, a long history of stability and dividends, and, crucially, very low valuation multiples. To be specific, he wants a price-to-earnings ratio below 15 and a price-to-book ratio below 1.5. No exceptions.
So how does NXP actually stack up for him? Well, it easily passes the size test at $67 billion. It passes the financial condition test with a current ratio of 2.24. It even passes the dividend test, currently paying out a 1.52% yield. But it completely fails his strict valuation metrics.
The PE is sitting at 25.49, which is way above his maximum of 15. And the price to book is a lofty 6.16, absolutely crushing his 1.5 ceiling. To put the final nail in the coffin for a true Graham value investor, we use his strict intrinsic value formula, the square root of 22.5 times EPS times book value per share. When we plug in NXP's 1045 earnings per share and an approximate $43 book value, we get an intrinsic value of just $100.55, which means Graham wouldn't even touch the stock at today's $266 price. He'd tell you to avoid it completely until we see a massive market correction.
Okay, Section 5, DCF and Valuation Models. Let's move past the historical gurus and build a modern discounted cash flow model based on the actual numbers. First, we establish our base. Looking at NXP's historical free cash flow, in 2023, they generated $2.51 billion. In 2024, it dipped slightly to $2.06 billion, but bounced back in 2025 to $2.28 billion. With the trailing 12-month free cash flow now hitting $2.96 billion, we've got a very realistic baseline to project our base case future cash flows over a forecast period.
So forecasting those free cash flows using the perpetual growth method, we assume a standard weighted average cost of capital, essentially our discount rate, somewhere between 8 and 10%, alongside a conservative terminal growth rate of 2 to 3%. Looking at the resulting sensitivity table, our base case fair value lands right around the middle at $215 per share. Notice that even the absolute highest end of our DCF model barely touches the current $266 trading price.
We can also triangulate this with a few other valuation models just to be sure. NXP's trailing EV to EBITDA multiple is 18.10x, and its price to free cash flow is 24.82x. Interestingly, though, the forward PE of 16.98x actually looks surprisingly cheap compared to its trailing metrics. This points directly to the fact that the market is anticipating some robust future earnings growth, and that expectation is what's keeping the current share price elevated. Finally, Section 6, Synthesis and Final Recommendation. Let's bring this all together. When we look at the summary scorecard, we see a stark divide based entirely on your personal investing philosophy. Deep value, defensive investors like Benjamin Graham, they would run away screaming at this valuation. Warren Buffett sees a high-quality moat, but might hold out for a better entry point to guarantee that margin of safety. Our DCF model also suggests it's slightly overvalued today, signaling a hold. Yet, growth at a reasonable price investors like Peter Lynch look at that 0.94 PEG ratio and see some serious upside potential. Ultimately, the entire investment thesis comes down to this core balance. You are weighing a deeply entrenched, highly profitable tech stalwarts. They generate massive free cash flow, return capital to shareholders, and absolutely dominate the future of automotive intelligence systems. But you have to balance all of that against the realities of cyclical semiconductor demand, a somewhat heavy $11.7 billion debt load, and a current price tag that honestly has already priced in a lot of near-term success.
The numbers are all on the table. If it drops to $215, the DCF model triggers a buy. If it drops to $100, Benjamin Graham comes out of retirement. But investing is deeply personal, and it depends entirely on your unique strategy. So looking at these frameworks, I'll leave you with this thought. Based on the data, where is your line in the sand? At what exact price does NXP Semiconductors hit your personal margin of safety? Thank you for joining me for this explainer, and keep running those numbers.